Hi, everybody. This is the Middle Class Investor. This is Seth Martin, your host. It is Valentine's Day, February 14th, and looking at a chart of the S&P 500, and this is a weekly chart, by the way. And you can see for the week we were down. We had an open here. We rallied up and then sold way off, and then rallied all the way back here and closed right here at the bottom of this candle, at this bar. And so, like we talked about, though, the market did come down and make a low below this low. So we were talking about a couple different possibilities. When we were looking at this last week, we were talking about maybe coming up, making a slightly higher high, and then coming down and make a lower low. Or it might just come on down and make a lower low. And it did the latter. There's the difficulty of where the market is right now. It's always a little bit of a challenge, but the reality is if this is the first move down, let's do some bigger picture stuff here. If this is the first move down, which it appears to be, to here, and this is our first correction into the first move, then this may just be the first move of the next wave down, in which case we would have some sort of retrace of this, probably into this area, maybe not even that high, and then the market would roll over. It's hard to say. It may not, how high it goes, you don't really know. But I would say that what I would say about where we are right now is, as it migrates its way up here, if it starts to develop some weakness above a high, let's say it goes up and makes a high off of this pivot here. There's a pivot right in this area. So let's say it goes up and pulls into this area right here and then sells off and then rallies again above this area. But if it starts to show any significant weakness on its way up higher here, in other words, if it starts to look like this and then starts to go like that, it may be that we have much lower prices to go before we get a rally that would close that gap. It's really hard to say, and basically what you have to do, what I think is prudent to do is go ahead and look for a place to sell into the strength. So if you're in a 401k, okay, and you've got all your money in the market and you're not liking the market, so let me kind of throw that caveat up there. What you want to do is you want to sell into strength. So you want to sell as the market's rallying up into this area. Now, whether it gets to this area or this level or this level or this level really doesn't matter if ultimately it rolls over and goes much lower. I think everybody should agree with that. Really all you're trying to do is you're looking to kind of cut your losses. You're not looking to necessarily get the perfect timing together, to get out of the market or whatever. If I had a little bit more, if I had a little bit better understanding of where we were in the cycle, I would certainly share that here on the YouTube channel. But to be honest, how high we bounce from here, it really depends. I think the shallower the bounce, probably the weaker the market is. I really feel like this gap is going to get filled, but I also feel like, man, there's a potential. That is a long way for this to bounce, and I really don't know if we have that. I think the market's really maybe too bearish right now for that to happen at this juncture. Another thing we could do is we could look at this move down, and we could take the lower high here, so this high right here, and we could use a Fibonacci, and we could grab that high and come down here to the low, and we can look to see where the 62% retrace is. That's very, very typical of a bounce back. In which case, if that's the case, then we're looking at a retrace into this zone right in here, right around 2000. I think if you get anywhere close to 2000 and you want to be out of this market, this is a great place to cut your losses and step to the sidelines, unless of course you already are there. But we do. The reality is we do have that gap up there, and I just don't have a good feeling about whether or not we can get all the way to that gap. So, everybody has to make their own decisions. That's the way investing and trading is. And I wish I could provide more insight, but at this point, I'm kind of erring on the conservative side of things because I don't want you to get stuck in this market wanting to be out and being very much in, wishing you'd gotten out. So I'm erring on the conservative side where, if we get up into this area right in here, around 2000, great place to sell. Take your money, stand on the sidelines, and just sit back and watch the mayhem from, afar. What's a good target on the downside? You could look at probably a good way to do that is maybe take a Fibonacci from here and come up here. And I would say somewhere around these October 2011 lows is probably where this first move is going to end. Once it really gets to accelerating, it could gap pretty quick and move pretty fast. And the perfectly logical place for this to end before we get any kind of substantial bounce will be in this these lows that go back here to 2011. I know it sounds crazy at this point, like there's just no way that could be, and that's fine. I mean, you can have that opinion, but we're going to be going through some probably some deflationary gyrations, and it's going to cause a definite sell-off in equities. Equities, it's generally conceded that equities are a little bit inflated, basically because of the QE, and we basically have another bubble. We have an asset bubble, and again, I'm not really. I don't want to. I'm not a soothsayer. Okay, I'm not someone who predicts things. I just know that. I look at the market, I look at what it's telling me, and the reality is, if we are where I think we are in the cycle here, in this wave structure, we're going to get a little bit of retrace into this area, and then you're going to see the bottom fall out of this thing, and it's going to be pretty shocking for a lot of people. They're going to look around. They're not going to really see a banking crisis again, although this will cause a banking crisis most likely. But right now, the problem is, nobody can see it, and so it just doesn't seem real, and it doesn't seem like it's possible. But again, the whole purpose of me doing these YouTube analysis each week is to help people stay out of the market when they really need to be out of the market. That's really all I wanted to do with this YouTube channel. So there it is. You can take it for what it is. but that's why I did this. So let's look since we've got the S&P 500, let's look at the VIX. Of course, the VIX spiked this week, but then pulled back in. We've seen this a couple times. It spiked, pull back in, spike, pull back in. So I think we got a little pull in here. I don't think we're going to go quite as deep this time on the VIX. Wouldn't be surprised if it pulled maybe just below this line and then rallied up. I'm not sure you'll see the VIX go back into this channel here. We might be above it for the foreseeable future. That remains to be seen, but that's kind of where I'm leaning. The 10-year, obviously the 10-year pulled back pretty deep and did actually make a new low below this low. But let's look at the big picture. This is what I've been calling the ultimate low. And so what do we have? We've got an important low. We've got an initial move up. We've got a correction, albeit long, right? I mean, it's over 2-year correction here. So you've got this kind of kind of an ABC, and then you got an ABC, and then an ABC. So this is very much a correction. The channel didn't quite hold up, and we pierced the channel for the week, but you can see that during the same week, the bears are really, you got to look at this almost upside down because it's the bond market, right? So what happened is the bond bulls drove the market up all the way up to here. Okay, all I did was invert this chart, by the way, so it can make sense. So the bond bulls, people who were buying bonds, drove bonds all the way up in here, and then the bears pushed them all the way back down. And this is a very this is either a bottoming or topping candle, depending on if you're looking at that, it's a bottoming candle. If you're looking at that, it's a topping candle. So, in fact, if we go back, let's just go back to the S&P 500 just for a second, and you can see a similar candle here. This one, this one, this one. These are all bottoming type patterns where the market reverses. Now, in these cases, it didn't. Well, in this case right here, it reversed and went significantly higher. In these cases, it hasn't really gone significantly higher yet. So, but it does tell you that the selling has stopped for the time being. So, when we look at the 10-year, this looks like an important candle here to me, and that the 10-year might be through going down. Maybe you may have seen this may be the low that you'll see for the next couple of decades. That remains to be seen, but usually when you get a reversal like this, especially in a corrective pattern, and this is very much a corrective, it could signify the bottom here. So just be careful. I mean, bonds are, clearly over the last, since last October, Thanksgiving last year, we've been making money in bonds, but those days are about over. If this really gets up ahead of steam, you could see yields go pretty high pretty quick to this 3.1, 3.2 area. So that's one of the reasons I've been cautioning about bonds. Basically these other global markets look very similar to the U.S. market. I mean, here's Germany, you got Japan. Japan's rates went negative. Clearly, that's not helping at least their market. Maybe it's helping some aspect, maybe their bond market. I don't know. I don't follow their bond market, but clearly it's not helping their equity market. The UK, all these markets look fairly, pretty similar. The UK broke this trend line way back here in 2014, September 2014, kind of retested, and then really has never looked back. Japan really never made it up into this area. Kind of consolidated, broke out, but really this is more of a failed breakout. And it looks like Japan's starting to accelerate to the downside. And I think you could probably see Japan down here in fairly short order. Let's see, what else do I have here? Do I have the euro? Yeah, I've got the euro US dollar. I've got another chart of the euro too, but this clearly was in some sort of consolidation, broke out, and then this looks like a correction for this move here. So I don't know if you're, those of you that are watching, if you're starting to see this over and over again, but you have this, you have a move, and then you get this kind of correction. Okay? And then the move is generally, it usually continues. I don't know if you're recognizing that yet, but I'm pointing it out pretty often. So you probably see the euro definitely below this area here, which marks the previous low. Excuse me. Let's go over and look at gold. Oh, this is the dollar. I'm sorry. So you have the high of the dollar way back here in 01. And we had this big consolidation, and then the dollar started to move up. And then I've had this area on the board here for a while, this resistance area. I think it's still valid, still a valid resistance area. Let's move it over a little bit since this is all taking longer than it looked like initially. But you can see that the dollar is pulling back again here, but this is only a correction. This is only a correction in this larger move. This whole area right in here is basically a consolidation for the dollar, and we should see it make a move up into here. And if you look at gold, it's more or less coinciding with gold. Gold really is kind of on a tear here, and I think you're going to see gold. We've got this box drawn on here. It's been on here for a while. I think you're going to see gold move up into this area, pull back a little bit, and then rally again. And ultimately, you're going to see gold, I think, maybe somewhere below this area here. Let me just draw that. Let's use a price level. This area right in this area makes a lot of sense for gold to rally up into this zone right in here above $1,500. So you can see gold here, maybe pull back, and then rally again up into this area. And then I would look for gold to resume its downtrend. It's been in a downtrend for a very long time. This is just a relief rally. The market gets stretched to one side and it needs to spring back. So you're going to see a spring back probably into this 1530 area before the market rolls back over and resumes its trend to the downside. Let's look at oil on NinjaTrader. Oil continues to. I'll tell you what. Let's look at oil here because I'm not sure that's the right contract that I have up on NinjaTrader. And sometimes if the contract rolls over and I don't update it, it can give us the incorrect price information. Let's see. This one's 29.47, 29.33. I'm not sure. I don't think 29.33 is accurate. I think 29.47 is probably the right number, albeit pretty close. So, we've been talking about oil potentially bottoming. Of course, it keeps going lower. But we should be very close to a rally in oil, and it should be taking us into this $50 area to $55 area over the next, many, many weeks. Um, and if you go look at some oil stocks, I don't know, ExxonMobil or ConocoPhillips, you're going to start seeing they're starting to have kind of a bottoming pattern here, where it looks like they've made a low, they've kind of rallied, pulled back, now they're rallying some more. This the stocks tend to move ahead of the commodity a little bit. So if you look at ExxonMobil, you look at ConocoPhillips. Well, ConocoPhillips doesn't look as good. Let's check out Chevron. Yeah, Chevron and Exxon look kind of similar. Get this move out, this pullback. So you might see, let's try like Apache. It doesn't look as good. What about EOG? EOG, it's a little bit shorter, smaller pattern, but these are probably telling you that oil's trying to bottom here down in this area, and that we're probably well on our way to a good rally into this $50 area. Now, look, you have your guess or whatever, right? Your analysis, but the reality is if it it turns and rolls back over, then oil's not through going down, right? So let's say you're interested in oil. Let's say you're thinking about buying oil or oil stocks here. What could we look at? What do we need to focus on in order to make a decent decision? And I think the best way to do that is to look at. Hold on, let me stop this. Freeze it. Oops. Let's try that again. So let's say we're looking at these two candles right here. Now these are weekly candles. So this is last week, and this is this week, I think. I think oil may already be trading. But let's go to next week. So let's say this week ends just like this. Or I tell you what, let's say this week starts like this, but ends up looking like that. Then, you could probably enter oil, okay? But then, like I said, if oil rolls over and takes out this low, then you pretty much have to admit you're wrong and that oil's not through going down. Now, another potential scenario is, let's say this week finishes like this, and then next week we get a week that looks like this. Well, then you can enter oil here. I think that's a pretty safe place to enter oil. In other words, wait till it's through going down, you get some sort of rally, and then you get a close above that rally, just to indicate that for the time being, the selling has stopped. What you don't want to do is go, I think oil's through going down, and you trade, you enter a trade, and next week looks like this, and then it goes like this, and then it goes like this, and then it goes like this, but you think oil is through going down. Okay? The problem is you can't do that. You can't think oil's going down and then just watch it. I mean, oil's going up and then just continue to watch it go down. That just doesn't work. You just won't make any money like that. So be careful doing things like that. Try to put some, methodology behind what you're doing. Let's look at the big picture. You can see kind of a three-wave move here, maybe, 1, 2, 3. And so we are expecting some sort of wave 4 up here, and then ultimately another low for oil out in the future. And then look, after that, we're going to have, one day oil is going to be $200-300 a barrel, unfortunately. But that's long term, like 20 years from now or whatever, that's where we're headed. So enjoy these low prices while you still can, because they won't last forever, I promise. Let's look at a bigger chart on the S&P 500. Look at a weekly, and just see what the weekly chart looks like. See, I've got my notes here with my drawings. I really should remove that for the purpose of You can see here we didn't go quite as low as I thought we would go. But you can kind of see you can kind of, well, I'll tell you what, rather than do that, let me just go to a daily. And then I'll just show you the swings. Zoom, do this. You can see the swings here. 1, 2, 3, 4, 5. This is the ES, okay? Now the question is 5 done? Probably not. If we take a DP off of this 3 here, you can see that 5 at least is going to go to here. And it could actually go quite a bit lower. In fact, if you look at, let's see, yeah, either off this swing here or off of this swing here, probably off this one. If you took a DP off this latest swing low here, well, you can see that's the higher time frame support. So probably the ES is not through going down yet, and we're probably due for some lower prices before we get up here. So maybe we get up here to this little DP support area and then wind our way down into this 1737 area or something like that. And then we start getting a big rally. And maybe then that gap gets closed. I don't think the gap is going to get closed in this near run up here. And the reason I don't think it will is because this just wasn't long enough yet. I mean, this move right here really just wasn't long enough. It really needed to come all the way down into here. And so because it didn't, I don't think it's going to go much higher than this area right in here. In other words, I don't think we're going to get to this resistance area. I think we're going to get to a shorter time frame resistance area around here and then roll over and make these lows. Then after that, after we come down here and make these lows, then I think you're in for a pretty big rally to here, maybe a pullback to there, get up here, close the gap, and then boom, down. So that, in a nutshell, is kind of what I'm looking for to happen. I'm still going to trade what I see, right? I'm not gonna go, I think this is what's going to happen, and just stick with it no matter what. That's a good way to lose money. Trust me, I've been there, done that, and you don't want to do that. I think that's really it for today, for Valentine's Day. I don't want to overload everybody too much. I've been rambling a lot. I feel like I've been rambling a lot. And really, I just want to make sure you know that I think there's still some risk to the downside. And it could be significant. I mean, we could come, just look at this channel. If this thing, so let's just talk about, what potentially could happen. Sorry about that. The announcement keeps coming up. It's because I've got to update this software. But let's say that this does come up into this area and then rolls over. We could come, down into this area. In other words, it doesn't have to stop at this DP. We could come to the bottom of this channel. That's why that channel is drawn on there, by the way, is to remind me that, hey, it doesn't have to stop right here mid-channel. It could come, all the way down here below 1650 and then rally up, big rally up, and then roll over again. So just be careful. We're in an area where it could rally hard from here, like all the way up into this area. But I think most likely we're going to get a rally up into this area and then roll over, make a lower low, and then rally hard. So just be careful. Your 401ks, sometimes if you get back in, let's say you get back in and you're looking for this big rally, you can't get back into cash for 30 days. So just have to be careful. Make sure you've got enough time that you're not worried about needing to make a move and not being able to make that move. So, all right, everybody, that is it this week for the Middle Class Investor. I really appreciate you coming in. Tell all your friends and family. Don't let them lose money. I don't know. It's hard because the media is so strong out there around. Sorry about that. The media is so strong out there around. You can't predict the market. You can predict larger picture. I think it is hard to predict day to day, week to week, but you can see a larger picture developing, and that larger picture is a very large picture, no doubt. It's been developing now for a couple of years, but it is possible to see it. You just have to train yourself to look for the patterns. So anyway, comment on the YouTube channel, follow me on Twitter at Investor Class, and come back and continue to look at the videos. And as long as you continue to come back and look at the videos, I will record them. So, all right, everybody, hope you had a happy Valentine's Day, and good luck to you in the markets. Take care, everyone. Bye-bye.